You're listening to Therapy for Your Money, a podcast about all things money and finance for therapy practice owners. If you want to feel confident and in control of your financial life, then you've come to the right spot. I'm your host, Julie Harris. I'm an accountant and the owner of Green Oak Accounting. My firm specializes in working with private practices across the U.S., and my team and I have worked with hundreds of private practice owners. I'm on a mission to share all the best practices I've learned along the way because I want you to have a profitable private practice. My new book, Profit First for Therapists, is available at most online retailers. You can get it in paperback, audiobook, or ebook as well. Go check it out. Hello, everyone, and welcome to Therapy for Your Money. Today, we have a three-time Therapy for Your Money guest. That's a very special honor. Not many people have, actually, it might be just you and Casey Compton. So I've just given it away. It's not Casey. But we have the one and only David Frank. Hi, Dave. Welcome to the podcast.
Hello. I'm honored and humbled to be back for a third appearance.
For a third time. So Dave, you're going to introduce yourself in just a second, but we are talking today about investing as a business owner. So of course, for that topic, I brought in my friend Dave. So tell us about yourself and what you do.
Yeah, so my name is David Frank. I am a certified financial planner or CFP professional, and I have my own financial planning practice out here in Los Angeles called Turning Point. And yeah, the focus of the firm is to help therapists in private practice manage every aspect of their financial life. So whether it's something you're struggling with in your practice, or whether it's something to do with retirement plans and investing and savings, or all the details of your personal savings life, personal finance life rather, that is what I'm all about. So I'm excited to be here and talk about how to invest and think about investing as a business owner, as a practice.
Yeah. And Dave, at this point, you and I, we have a lot of clients in common because that's what you do, right? You are a financial planner for therapists specifically. My firm works exclusively with therapists in private practice, but you're just an overall good guy. And that's why I wanted to bring you on for this topic, right? Just for anyone who's listening, who's new to Therapy for Your Money. I always am really careful about bringing on guests who have your best interest at heart and who are in this to benefit therapists in private practice, right? And Dave is just one of those people. There's a lot of slimy folks the in the financial planning world that say they care about their clients, but their actions show otherwise. And so that's why Dave is here today. So let's jump into it. When you are a business owner, Dave, what are some of the things that you should do investment-wise for the business and for yourself personally?
Yeah, so I think and it sort of ties to sort of what you were saying too. There are a lot of financial professionals out there. It's difficult to navigate the financial world and to get real solid advice. And the reason for that, or at least part of the reason, is that when especially you're a business owner, there's some fundamentals that you want to make sure that you have established before you go and jump into investing. And so the reason that becomes challenging to get good advice is that because the vast majority of quote unquote financial advisors, and I use that term loosely, that are out there.
You're using air quotes, right?
Air quotes, yeah, exactly. I know you can't see them. But they're compensated in a way that whatever they sell you, the more they sell you, the more investments they get you to put your hard-earned money into. In some cases, the bigger the insurance policy they sell to you, the more that they get paid. And so I work as a fee-only financial planner, and I really, regardless of whether you work with me or not, I really encourage, especially business owners, to look for fee-only professionals. And what that means is that the only way I make money is by what my clients pay me directly. So I'm never making money by recommending a certain product, whether it's an investment product, a mutual fund, an insurance policy, or even a course I'm recommending. I'm recommending something because I truly believe it's in your best interest. So in that regard, as a business owner, what I think is really, really important is that we talk about something pretty boring, which is an emergency fund. So that is going to be the absolute first number one thing I want every business owner to establish, both in their business and in your practice, as well as in your personal life. Because I've seen time and time again where a practice owner has a phenomenally successful year. There's a lot of money that we could do different things with. And if we don't build up an emergency fund, sooner or later, something is going to get a little wobbly in the business because that's just what happens.
Just how it goes.
That's
Yeah.
just how it goes. Like it's just part of being a business owner. So I think a personal business. So on the personal side, I like to see folks have at least a year's worth of spending in liquid accounts. So liquid means that you can easily access them without penalty. So at least 3 to 6 months worth of personal living expenses in a boring old high yield savings account. So, 3 months, if you're a dual income household, you can be closer to 3 months. If you're a single income household, generally I'd like to see you be closer to 6 months.
Oh,
Beyond that,
interesting. I
yeah.
have not heard that distinction
Oh, really? Okay.
before. Yeah, that's actually new to me. 3 to 6 months, very common, but 6 months if you are the sole earner in in the household because there's more risk. Is that
What?
correct?
Yeah,
Yeah.
exactly. So, like, the chances of two gainfully employed or gainfully income producing individuals both having, a bad year at the same time, that's less likely to be the case
Yeah.
than if there were just one. So, yeah,
Okay.
just a risk management thing, playing the probabilities.
Got it.
Um, and so, that isn't very interesting, but no one gets excited about
It's
saving
pretty
money into a
boring.
bank account. It is really important. And then I think beyond that, like you probably don't want to have a full year's worth of living expenses just sitting in a bank account because even if you've got the best high yielding bank account, it's still going to be a reasonably low interest earning account. And then you still have to pay taxes on it. So I think you can invest somewhat conservatively a little bit beyond that. But in any event, like at least 6 months of living expenses, I'd like to see you have that built up before we start going and putting money in spots where it's more difficult to get access to, like a retirement plan or a retirement account. So
Okay.
yeah, so
And
let me stop
so
there for a second.
right now, we're recording this in Q4 of 2024. Right now, we can actually get better interest rates than we have in previous years, right? In just a
Yep.
boring old savings account, 3.5 to 4.5 ish percent, right? Is that about what you're seeing? Yeah.
Yeah, about
In
that.
that ballpark. Whereas in 2020, that was like 0.5%, right? It was almost nothing. So it's not bad right now, but that money is not meant to be making money for you. Like it's just staying there safe and it's not going to go
Yep.
up or down.
Yep. We
Okay.
are we are sacrificing some long-term return potential. And the reason we're doing that is just it's safety.
Yeah.
Um, because we don't want you to be stressed out because like when we're stressed out and we're running out of money, that's just a stressful time if the business isn't going or your practice isn't operating the way you want it to. So we don't want any additional stress to be on you. And so we just want you to be able to tap into that emergency fund.
Okay. And so beyond the 6 months, where's that cash going?
So, in general, like if you're just getting started with investing, for most of my clients, what I'll have folks do is put that access above 6 months into what's known as a taxable brokerage account. So that is one type of an account through which you can invest. Retirement accounts are a different type of account through which you can invest. So I general generally I'm going to recommend the same type of investments go into both of those accounts, but the taxable brokerage account is going to be invested a little bit more conservatively because you might have a shorter time horizon there. So that's kind of generally how I approach it. So yeah, let me so let me
Okay.
stop there again.
Yeah, and so what I hear you saying, because I understand the tax behind it, is you're doing this in a taxable account, right? Not because you like the interest being taxed, but because that gives you most flexibility. Whereas if
That's right.
you're investing in a retirement account, if you withdraw those funds before you're 59 and a half, you're going to pay a 10% penalty. So you will also pay tax at that
Correct.
point, but the 10% penalty that you never get back. And so that's the difference, right?
Yep, that's exactly right. A taxable brokerage account that sounds a little bit funny, but the reason we use that word is because the alternative to a taxable brokerage account are tax advantaged accounts. So retirement plans, 529 plans, those are all great things to use, but they offer tax advantages And with those advantages come downsides or come restrictions. And the primary restriction is that you can't get easy access to those funds any longer. So you'd have to pay that penalty. So yeah, it's worth kind of doing something a little bit less tax advantageous to
Mhm.
again provide some liquidity for times when you simply need the money.
Okay. So let's talk about what you do on the business side.
Yeah. So on the business side, sort of same strategy is we are going to start with an emergency fund. And the two things that I like to have in place are, an emergency fund, which again is just going to sit in a blind old bank account. And depending on how your practice is structured, depending whether you're a solo practitioner or group practice owner with multiple employees, and what your overall compensation model is, that's going to dictate how big that emergency fund is. And a lot of times I like to see it supplemented with a business line of credit if possible,
Mm,
provided that you're not going to be tempted to go and spend the money from the line of credit, but just kind of have it there in case of emergency. But an emergency fund is still going to be better because we all know like lines of credits can be withdrawn, they can be retracted in times of financial crisis. And I know we saw
mhm.
that happen in the beginning of the pandemic. Uh, but those two pieces I think are usually make sense to have in place. An emergency fund always makes sense that to have in place.
Okay, so emergency fund, line of credit. I know I have guidelines for how much the business emergency fund should be, but I'm curious what yours is.
Yeah, so it is typical. So it's typical to get a lot of sort of different variants on this. So I
Mhm,
typically think I like to have 1 to 2 months worth of so ignore your compensation, what you're paying your
mhm.
employees, 1 to 2 months of operating expenses. So even if you're a solo practitioner, you've got a certain degree of operating expenses. So we're talking about, rent, advertising expense, insurance expense, like
Your
the
website, your
math practice.
software.
Yeah.
Yeah.
Just all these different things like, yeah, EHR software, whatever you use. So that, 1 to 2 months worth of that in the emergency fund account. And then when it comes to compensation, if you're a group practice owner, somewhere that's kind of like the same, like 1 to 2 months worth of compensation expense, if possible. This is hard. This is difficult to reach.
Yeah.
It can be a real lot of money. And the other problem is that as a small business owner, chances are you're going to be taxed on that money you're trying to save up in the business. Like the
Mhm.
income flows through to your individual tax return, and so you're just going to get stuck with the taxes. So I think it's not like you have to have that fully funded, on day one, but sort of chipping away at it, using an allocation. If you're using profit first, using an allocation to building up that emergency fund can be helpful. Um, but I'm also curious, Julie, what is your
Yeah.
recommendation?
I mean, we're in the same ballpark. So I usually say 1 to 2 months of expenses, including payroll though. So I'm
Got it.
including payroll in that in part because in the setting of a group practice, a lot of times, even if all income stops coming in today, you still typically have one or two payrolls that you owe your team beyond that, right? So I'm thinking kind of
Yep.
worst case scenario, even if money stops coming in today, you have to pay your team members for last week or the work they did for the last 2 weeks or last month. And so um, that's why I come up with this number. I would love for it to be even more, right? But I think to be realistic and say to a group practice owner, you need 3 to 6 months worth of expenses. That could be $2 million for a group
Right.
practice, right? Like
Can be
there's
a
just
real
not.
lot.
You're probably not ever going to have $2 million in cash just sitting around. So I try to get a realistic view, knowing like if money stopped coming in, you're going to start cutting things pretty quickly. In part,
Right.
your own salary, you're going to reduce hours, right? Like you're going to hopefully take cost cutting measures really quickly, use the line of credit, and then things will get back. So I always hope it's just a blip on the radar versus a permanent downfall. Um, but 1 to 3 months. I vary my recommendations a little bit depending on the day and the risk I have seen recently, I think.
Yeah, I feel the exact same way. And I think like all human beings, like we have this like recency bias. So like we
Mhm.
we tend to remember what's happened more recently. And as we record this, like we all remember the change healthcare fiasco that happened just a handful of months ago. So I think we're likely to be more risk averse at this
Sure.
moment, which is not bad, but I think it's like hopefully the next several years play out and things go really smoothly. And so like that's when I start to worry a little bit because everyone's like, everything's going great. I don't need this emergency
Fine.
fund. So that's when it's like, let's have at least a month's worth of expenses.
Okay. Well, so let's move on. After the emergency funds on the business, on the personal side, then what? What do we do?
Yeah. So then I think from there, usually it makes sense to start saving into a retirement plan or a retirement account. And so these are, as I mentioned before, tax advantage vehicles.
Mhm.
Um, there's a lot of different retirement plans out there, and there's a lot of complexity in terms of like, how do you choose the right one for yourself? So usually you can just start with a plain old IRA, whether it's a traditional IRA or a Roth IRA. They're both good options. I think if you've never invested into a retirement plan before or a retirement account, get started with one of those. And then the question is, of course, what do you put into that retirement account? So the retirement account or retirement plan itself is just it's just an account type. It's just a home for your investments. But
Mhm.
then you subsequently, after you've decided what sort of account type you have, then you have to decide what type of investments to put in them. And in general, especially when you're just getting started investing, I like using target date funds. I'm partial to Vanguard target date funds because those are the ones that I'm most familiar with, although there are other decent ones out there. But these are just very diversified funds. They're all in one funds, which means you just have to buy that one fund and you're going to be well diversified. It's going to be risk appropriate for what your time horizon to retirement is. It is a great way to get started.
Okay. So you're saying basically if I'm planning to retire in 2045, we're just throwing out a number, I could put 100% of my retirement funds in that one fund, and it's going to contain the right number of mutual funds and bonds and all the things. Is that
Exactly right.
correct? Okay.
Yep.
Oh,
Yeah. And these funds are typically, they come in 5 year increments. So there'll be a target date 2030, 2035, 2040, 2045. So you just figure out about when you're going to retire and then pick the fund that has the year closest to your retirement year.
okay. Does that do you ever get clients who say like that feels just lazy? Like that's the lazy, like shouldn't I be doing more work to try to
Yeah.
figure out what to put in there?
Yeah, no, I do get that comment sometimes. It's just like, doesn't this have to be more difficult? Like that, it just doesn't seem right. And the truth is that we usually commonly we overthink investing. Like
Mhm.
investing, like Warren Buffett is one of these like famous investor who, you know, has this great reputation. He's invested very well over the long term. And he also talks about the virtue of being a lazy investor, of doing
Mhm.
nothing. And it's really about, just keeping things as simple as possible and then just sticking with the plan no matter what happens as the markets go up and down, which they do. That's just something they naturally do. So just continue chipping away at retirement savings, putting in a little bit, every month if possible into that retirement account and just keep it as simple as possible. I do think like once you've started to amass a fairly, significant, what feels significant for you amount of investments, that can be a really good time to check in with a fee only financial planner just to be like, hey, is this still an appropriate investment for me? Should I be doing anything different? There are, it's very individual. It depends on what the cases of what your personal financial circumstances look like, but it can make sense rather to move away from that one fund solutions. But in most cases, especially in the beginning of savings, it does make a lot of sense.
Okay. So one question I get a lot as the accountant is, um, how much should I be saving as a business owner for retirement or otherwise?
Yeah.
What
So
what do
it
you
it really it depends. Like this is a very difficult answer to give generically, but
Mhm.
in general, like if you can be saving 15 to 20% of your income, you are going to be in a fantastic place. So that is 15 to 20% of your pre-tax income, which can be kind of a tricky number to figure out. The thing I typically tell people to go is to like dig out that most recently filed tax return, look at the first page of the 1040, which is just an individual tax return, and find the line item that just says total income. And like that total income is all the money that you have coming into your personal life. So if you can be saving 15 to 20% of that number every year, you're going to be in more than likely a very, very strong position. And just know that it's difficult to get there. You can't get there overnight. So start where you can, build the habit of savings, and just try to work up over time.
So when it comes to business owners themselves, like, I kind of think of that number as part of your compensation package from the business, right?
Yes.
So,
Yes.
especially if I'm thinking like that, not 15 to 20%, it's a simple number if you're a solo practice owner where it's not easy to get to, but it's still pretty simple, percentage because you're generating all the money that the business makes. But in the case of group practice, like you're probably using some money or saving some money for expansion or for, um, just retained earnings or savings, the emergency fund in the business. So
Right. Yep.
I kind of think of it as 15 to 20% of what you get to take home. What do you think of that?
Yeah, no, I think that's exactly right. And because what you're taking home is kind of the most relevant number because it is, saving for the future, really all we're trying to do is to enable you to be able to maintain your lifestyle, your
Hmm.
personal spending into your retirement years or into your, I like to call them work optional years. So how much money you're
Mm.
actually bringing home and actually spending in your personal life is really the target that we care most about. So, yeah.
So speaking of that, how do you figure out what your number is? Like how much do you need to have saved to live your work optional years?
Your work optional years. So, what I generally like to target people for it towards rather is 30 times your annual spending. So, let's say your personal spending is about $100,000 per year. We'll multiply that by 30. So $1 million, or I'm sorry, $100,000 times 30 yields $3 million. So that's the target that you ultimately want to get to, that 30 times number. So if you can reach that number, you're going to be in a very solid position for a 30-ish or so year period of having work be optional for you. You might not like you don't have to necessarily have to get exactly there, but if you can get there, you'll be in a really, really solid spot. So that's always what I'm trying to guide people toward,
Hmm.
even if we know we might not ultimately get there.
Okay. And is that number the same if you are listening right now and are really close to retirement? Maybe you're, 64 years old and a therapist, you're wanting to work a few more years, but you're not anywhere close to that. Then what?
Yeah.
What's the number?
So well, I don't know that the number doesn't necessarily change because it's a sort of a rough rule of
Mhm.
thumb. So I think if you're in the last 5-ish or so years before you're hoping to quote unquote retire, I think that's really the time where you want to meet with a financial professional and just be like, hey, what are my options? What do you see? What are the different levers that I can pull? Because if you are struggling to reach that 30x number, and a lot of people will, to
Mhm.
be honest with you, it doesn't mean all hope is lost. Like there's still, Social Security earnings that most of us will be out there to receive. And I know there's been a lot of press about that, being underfunded. But the reality is that likely Social Security is going to be there. And there are some other financial products that you can consider using, like, converting some of your savings into an annuity can sometimes make sense if you're a little bit on the tighter side. But I think the most important thing as you get closer to retirement is just to start to have more clarity and understand what are some of the trade-offs or sacrifices that we might have to start thinking about to make sure that we will be in a financially sustainable position. And I mean, these things are scary to look at, and it can be overwhelming. So I think finding a financial professional that you like and feel comfortable with and feel that you can trust, and that would just sort of be there to kind of hold your hand and make you feel less alone going through what is a pretty scary and major transition can be of a real benefit.
Yeah. And what if you're too scared to find out? Like I feel like that has come up often where I'd almost
Yes.
rather not know if I'm gonna be okay and just pretend it's not happening. What
Yep.
would you advise someone in that position?
So I think that if that's a very human response, right? Like avoidance is a coping mechanism. We all know that. I would say, in that case, what would you? We're all, well, you and I aren't therapists, but most of the people listening to this are. So, if a client came to you in that situation, what would you say to them? What are some tools that you would employ to sort of work through that anxiety or that fear? A lot of times with my clients, we will hit up against, money beliefs or just money anxieties, and we can work on that to a certain degree. But I often am telling folks or clients, hey, this is like we've really kind of unearthed some great things for you to go and work on with your own personal therapist and then check back with me. So I think,
Mhm.
writing about it, just journaling, talking to your own therapist about anxieties, and what's holding you back. I think that can be helpful. But the biggest tool is talking to someone about it. Once we sort of get it out of in our heads and talking about it with a family member or a trusted friend or a professional, if you feel you're there, it's when we get in conversation and invite someone else into that place that feels scary. That's when things start to shift.
Ooh, I like it. So one, we've talked about emergency fund, line of credit, retirement. What do you think is the next item after those?
Yeah. So I think those are the big sort of financial pieces. If you're saving significantly into a retirement fund or different investment funds, then I think for the folks that I work through, the next thing that we really want to think about, and even before we fully check those boxes or feel comfortable with them, is just to start to think about your overall risk picture because helping people navigate risk is really what I do as a financial planner. So
Mhm.
the next big two topics beyond that are really thinking through on your personal side, like what are the right insurance policies to have? Do you have an estate plan in place? Do you have an emergency sort of response plan or business continuity plan for your practice? What would happen if you're not able to show up for work one day? So thinking through those pieces, and it's all a lot, which is sort of like why I have
Yeah,
a job, right? Like, how do we prioritize these? Yeah, what's the right order to work in? Because of course we can't do it all at once.
yeah. It's a lot all at once. Where would real estate fit in this picture?
That is a great question. So I think real estate sort of has can have a place in your overall portfolio, but diversification is a major theme of financial planning or just like financial theory in general. And so I like to see people's net worth be sort of diversified into sort of different buckets. So, the retirement plans is sort of one bucket of wealth. Your practice itself, especially if you're a group practice owner, will be another bucket of value or wealth that you're building up. And so real estate can be another piece of that. In general, long-term real estate returns tend to be lower than what we see in the stock market, which
Okay.
is very difficult for people to believe because we hear so many stories that are contrary to that. So real estate is almost always going to be a very concentrated investment, which means that there's a handful of different risks that can really change the value of real estate. Right now we're folks in Western North Carolina are navigating through the aftermath of the tropical storm that went through and all that flooding. That's the type of thing that can happen to sort of any individual piece of real estate. And that can really challenge or just it can create some stress in the financial plan. So I think real estate can be an important diversifying element. But again, as with all things, don't put all of your eggs in one basket and think
Mm.
that the only way to build wealth or the quote unquote right way to build wealth is to focus on real estate.
Yeah, and I would say just based on the questions that we get on the accounting side, real estate, if you don't have an emergency fund, to me is just a do not pass go, do not collect
Absolutely.
200. Like you should not even be considering it unless you have a fully funded emergency fund. Because when you buy a building, things will go wrong. Or even when you buy the house that you live in, if you have $0 left at the
Yes.
end of that transaction, you're putting yourself up. You're in a pretty risky position. I would also say to me, retirement needs to come before that. Some retirement savings, right? Not that you're
Yeah, I agree.
maxing everything out, but like if you
Yeah.
have zero cash flow and you're putting $0 a year into your retirement fund, you probably also can't or should not be buying real estate quite yet. Um, because once that time passes, you can't go back and put money in for previous years, and so it's just gone. So that's my opinion. How do you
Yeah.
feel about it?
No, I feel the exact same way. So the thing about real estate is it is in some ways actually similar to a retirement plan, and that either one of those investments you make, it's difficult to get your money back out. Like you
Yeah,
just
that's true.
can't do it at the drop of a hat, which is why, investing in areas like I mean, putting money into an emergency fund is investing it. It's just like a different type of investing. But I absolutely agree that real estate, if you don't have enough liquidity, if you don't have enough easy access to cash, it can be, a real challenge. And one thing I always like remind people when they're looking at buying, especially a home, so like residential real
Yeah.
estate, distinct from
Like
commercial
to
real
live
estate.
in, right?
Yeah, like, and that can be an investment as well, but you should really factor between like 1 and 2% of the value of that real estate. That's what your budget for annual maintenance should be. You're
Mm,
not gonna spend that every year, but there's gonna be some years where you're gonna get this this unwelcome bill of
yeah.
replacing roof or redoing sewer lines or whatever it is. You should be planning. So like if you're buying $100,000 house, and that's pretty tough to find a
Which that doesn't
$100,000
exist
house.
anymore,
It
right?
doesn't exist this way.
Yeah.
But just know for every $100,000 of purchase price, you should be budgeting $1,000 to $2,000 of expense each and every year. So that's beyond mortgage payment, beyond property taxes, beyond, you know, um, I'm forgetting is one thing, but like that is an additional expense that ideally you should be setting, money aside toward.
Yeah. Yeah. It's a lot. Uh, As my house is about 10 years old, and there have been a lot of those little things in the last 12 months. A lot of those things that have been quite expensive. Yeah.
Yeah. And a 10-year-old house is not that old either.
Right. And I know it's really not that old, but it's funny how many of those things can come up all at once.
Yeah. Yep.
And then so as far as investing in either residential property to rent out or a commercial building, right? Because we work in the therapy space, a lot of our clients want to buy a building for their practice, which can be a great investment,
Yeah.
but not always, right? Commercial real estate is in a funky place in a lot of markets.
It really is. I mean, commercial real estate is really kind of a different beast, than residential real estate. So again, the fundamentals need to be in place. I think you want to have a lot of liquidity. If you're buying a commercial building for your practice, honestly, I think it's really a time to, talk to your financial professionals and sort of
Yes.
really run some numbers. Don't let your sort of gut or don't let it be just sort of a gut-based or intuitive decision. Don't let it be sort of a prestige, purchase, meaning like,
Mhm.
oh, like it'll look cool or feel cool. Really have someone help you look at some of the numbers and make sure that it makes sense because it is one of these. It real estate, whether it's commercial real estate or residential real estate, it can make sense in financial plans and in business financial plans, but it introduces rigidity. There's less flexibility once you're owning real estate, and you can't undo those decisions quickly. And sometimes, if you want to sell the building, it can't always be sold. And even if it can be sold, it's going to take some time.
Yeah. Yeah. And what I've also noticed on the business side is once you buy that building, you can often tend to conform your practice to the building, right? Well, we have the
Yeah,
building, so we
right.
can't grow more because we're out of space and the building can't hold more people. Whereas if you had flexibility, you might have said, okay, well, we have now outgrown this space. Let's go look for a larger space that will fit our current needs. And then you have the real estate, you make your real estate decisions in order to fit what the business has become versus the other way around.
Yeah, exactly. Yeah, and it's funny like how that kind of plays out. I also just like to add as sort of as a data point of like the biggest, big publicly traded companies, like many of them don't want to own real estate. Like
True.
they've made intentional decisions to like do these sale leaseback transactions where they actually intentionally sell their commercial real estate to some other investor, to someone else, and then they don't move out. They lease that office space back from the other entity because it does offer a lot of advantages and it can be a really smart thing to do as a business owner not to own real estate. So again, it's very case dependent.
Okay, Dave, I'm going to go on a tangent here. Listeners, please just bear with us. Amazon recently announced in the last few weeks that they're asking their employees to return to work 5 days a week. I've heard that that's because they own most of the real estate. Have you heard something similar?
Oh, no, I didn't know that. I'm not sure. That's really interesting. Yeah, I'm not sure.
Okay. So I don't know if it's actually true, but that would make sense, right? You own the real estate, you want it to be utilized, so you're forcing people to come back in. Anyway, I don't know if that's
Yeah.
actually accurate. All right. We do need to wrap things up, but you briefly touched on life insurance. It is a hot topic for me. You and I have talked about it often, not
Yep.
on the podcast, but what kind of life insurance does a practice owner need?
So again, this can be complicated, but if you were looking for life insurance to help protect your family and provide resources if you were to pass away in an untimely way, term life insurance is really the way to go. So there's term life insurance or whole life insurance. Whole life insurance is this very complex product that is often pitched as an investment, which it sort of is, but it's very complicated. It's very expensive. It almost never makes sense as the right thing to do. Term life insurance, on the other hand, is called that because you buy it for a period of time, a term. So 10, 15, 20 years, you lock in a price payment that you're making every month or every year. And then once it's done and it's relatively cheap, much more affordable than whole life. So I would start there. Um, if you have a more complicated situation, like you're entering into sort of like a cross purchase arrangement, or you need to buy someone out of a business, there are some situations where whole life insurance can make sense. A G person life policy, life insurance policy might be a whole insurance policy, but a lot of times it also can be done with term insurance. So I would start with term insurance, and be very cautious about purchasing any whole life policy because they more often than not don't work out the way the purchasers intended them to.
And I think, Dave, I have an episode coming out in a few weeks about whole life insurance and how I think it's a garbage product. I'm not putting words in your mouth, but I think most people who have whole life insurance should actually just have term life insurance.
I totally agree with you. I think it is generally, there are use cases where it makes sense.
Mhm.
There are times where it makes sense,
I will
but
give it
they
that.
are a vast minority. Like
Yeah.
if you just are an individual person, and you're not looking to do a complex business transaction, business ownership transaction, if you're not trying to structure something to minimize the impact of estate taxes, which virtually no one listening to this podcast needs to worry about estate taxes, then it just makes sense to avoid the whole life insurance quagmire entirely.
Yeah. And based on the current tax law, you would have to have an estate for each person, right? So for a couple, double, over $12 million when you die. So for a
Yeah.
couple, over $24 million. So
Yeah.
I mean, most people would love to have that kind of estate to leave to their heirs, but in most cases, the estate is significantly under that.
Yeah. And I think it is, people might scare you by saying, like, yeah, but that number is about to expire. It's going to drop, I think, in what, 2026. And yes, that might happen. Nothing's guaranteed. But the exemption is still, well, I think it would drop to like $6 million a person
Yeah,
or something.
about half.
So, yeah. So it's $6 million per person, $12 million for a married couple. It's not a lot of people that are going to have to worry
Yeah,
about that.
it's still a lot of money, and that's if it expires, right? That's still an if at
Correct.
this
Yes.
point. There's no indication that that will be, we don't it's too soon to know, but it's possible that that will be extended as well.
Yep.
Okay.
Agreed.
All right, on that note, we went longer than we wanted to, as we typically do. Um, Dave, you have a freebie for our audience. Can you tell us about that?
Yeah. So, we've hit on a lot of different things. We've touched on retirement plans today, but the truth is that picking out the right retirement plan for yourself as a practice owner is a complicated situation. So, we have a webinar that we recorded together that folks can get access to. So, there should be a link to that in the show notes. And it walks you through exactly, like if you're a solo practitioner, here's how to evaluate the different retirement plans available to you. If you're a group practice owner, here, and the circumstances are different in that case. So like here are the retirement plans that make sense for you. Because the truth is there are so many retirement plans out there.
Yeah.
It's confusing and overwhelming. But the truth is, like I think that webinar, I think we do, if I do say so myself, I think we break it down in a really easy to understand way to really simplify things.
Yeah, and like, here are all the options that you have available. Here's when you might want to choose this. Here's when that might
Yeah.
not make sense. Yeah, we go through a lot of different details. And I did want to mention, Dave, since you are a three-time guest, that you are also on episode 19 and 59. And so if you want to hear more about Dave, go back to those episodes in the archive and check out episodes 19 and 59. And for the retirement plan webinar, go to therapyforyourmoney.com, look at the show notes, and we'll have that available for you there.
Fantastic.
Dave, thanks so much for joining me today. Where can folks find you if they are interested in working with you?
Yeah, if you want to just consider working with me, I offer a free initial fit meeting. My website also has a ton of free resources and guides that you can download. So you can check them all out. The address is turningpointhq.com. So turning point and then like the abbreviation for headquarters hq.com.
Perfect. We'll put that in the show notes as well. Thanks so much.
Thank you, Julie.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.